The Federal Reserve Bank of America last week said it would continue to purchase bonds in light of a weakening economy. But how weak is the American economy really? Is it sufficient just to rely on data alone, or is there a more deeper reasoning behind the mixed opinions from analysts that the US economy is on the highway to recovery? Well, joining me on the line is Girard, a senior US economist with RBS, to help answer these questions. Michelle, thanks for joining me today. Let's start with the Federal Reserve. We know that house prices in the US have been steadily improving over the last year, which is a very positive development on the state of the American housing market previously. Yet despite a general sense of optimism about a full US recovery, Fed Chief Bernanke might actually increase the bond buying scheme instead of decreasing it. Now, I know this is nothing new, as we've heard this last week, but how long do you think this will last?
Well, you're exactly right. We are absolutely seeing signs of improvement in the housing sector, which is a very encouraging development after so long waiting for the turnaround to be seen. But, away from housing, or even despite housing's recovery, we are still looking at an overall generally subdued level of economic expansion here, and we're still looking at only a very gradual decline in the unemployment rate. And the other factor is on the inflation front now, we're actually seeing inflation moving lower. So in effect, the Fed is missing, if you will, on both its mandates, and that's what has sparked talk of the Fed actually increasing the size of its monthly purchase pace. I think that talk is probably a bit overdone. I do think the hurdle for increasing the pace of purchases from here is relatively high, but I do expect that the Fed will continue to be buying at this current pace probably for most of the year, and I wouldn't even rule out at this point the possibility of the buying program spilling over into 2014 as well.
The other issue, of course, is related to quantitative easing. How much longer can major central banks like the Fed, the BOJ, the ECB, etc., go down this route of printing money without serious consequences at the end of it all? If we take the Fed, for example, there may come a time where markets just don't swim up and bite the bait. What will happen then?
Yes, you're exactly right, and of course this is the concern that many of us have. I certainly hear people arguing when you look at, for example, what the Bank of Japan will be doing, particularly looking at the Bank of Japan's balance sheet as a percent of GDP. By comparison, what the Fed and other central banks have done looks pretty muted, and so many argue that I'm not open-minded enough about just how long we can see the Fed continuing to provide this kind of support. But I am worried about where this all leads, and you're exactly right. At some point, if markets lose confidence in the Fed, if perhaps there's a feeling that asset prices are where they are for reasons other than the fundamentals, that the fundamentals don't support, for example, stock prices at these levels, then you could see asset prices come down, and no amount of Fed support will stabilize the situation. And of course, that would be the worst case scenario all the way around for the U.S. economy as well as for policymakers.
Do you not think that started to happen already, though?
At this point, I don't. I certainly continue to see and expect that we will continue to see the equity market in particular improving as a result of the Fed's buying program. I also do have to say I don't think that the improvement in stock prices, looking specifically at that asset class, is necessarily unjustified. I mean, there is a fundamental case to be made for the fact that U.S. equity prices are rising. Corporate profits here in the U.S. have enjoyed a real V-shaped recovery, kind of in contrast to the subdued recovery and expansion we've seen in terms of growth. Companies are very strongly positioned in terms of their balance sheets, and they're able to make good profits even on relatively subdued growth. It is this profit margin expansion that everybody's talking about. So, again, I'm not sure that I think it's the only reason stock prices are up is solely because of the Fed, although that is certainly one factor that is fueling the run.
Okay, looking ahead with all this in mind, Michelle, what's the next move for the Fed and the US economy? And can you give us your interest rate projections?
We continue to expect really more of the same on all fronts. Our expectation for growth is that it continues to be pretty subpar. We've got a slower pace of growth in the second quarter at around 2%, down from 2.5% in the first, and then just gradually picking up back toward that 2.5% mark over the course of the year. I mean, for the full year, we're only looking at growth around 2%, inflation staying below the Fed's target rate of 2%. I mean, none of that will challenge either the Fed's current policies or interest rates. We think, as I said earlier, the Fed could easily be buying well through 2013 and even a bit beyond that. And I think all of that then argues that we are likely to see market rates, 10-year yields holding, kind of around current levels in the range that we've seen, perhaps 160 to 220 is our range for the course of the year. We do not anticipate, particularly given this backdrop, any real significant risk of a sharp, sudden upward move in terms of Treasury yields.
Okay, thank you. Some interesting thoughts to savour there on the Fed and the US economy. I'll be back tomorrow with the weekly wrap-up, but for now, goodbye.